Thank you. Good afternoon, everyone. I'd like to welcome everyone to our January 24th meeting, a special meeting of the CERS Investment Committee. We have sort of a major two items on our agenda this afternoon, but we'll have the processes that we usually use to start the meeting. And we'd like to begin with the opening statement. Is that going to be by Vicky this afternoon, or
I've got it.
you've got it? Okay, thank you.
All right.
Please proceed.
All right. This is a special called meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public via Facebook. If you are speaking and are not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you, Eric. Sherry, would you do the roll call, please?
Be nice if I wasn't muted, sorry. Dr. Hackbart.
Here.
Mr. Cheatham.
Here.
Dr. Milkman.
Here.
Mr. O'Mara.
Here.
Thank you.
Good. Thank everyone for being here this afternoon. Sherry, do we have any public comments?
Yes, sir, we do. We have received 3 public comments, and I will read those
Please.
At this time. The first one we received was from Mark Doran. And his message is, I'm a retired CERS member. My employer and I both contributed to a plan that was 100% funded during the majority of my career. Then the unfunded liability exploded when it was my turn to benefit. I totally understand the underfunding concerns and the necessity to address them, but our last COLA was 2011. No one can really expect retirees to live on a stagnated benefit forever. I understand the legislative responsibilities and the legislative actions regarding CERS in the past 15 years, the funding responsibility, and the CERS board relationship. In short, it's built a red tape system of no accountability to the CERS retirees. My question to you is, how do you plan to represent retirees regarding a cost of living adjustment? Currently, a COLA would require funding from the contributing participants. Politically, that is a move CERS does not want to make, so other options to tweak legislation for COLA funding should be explored. The legislature won't move without your input, and we're depending on you to represent us all. What help do you offer us, Mark Duran? The second comment is from Ezel Michael. And this individual states, we need to stand up and let the legislators know that the retirees of both KERS and CERS need some relief from the effects of inflation, even if it's just a one-time adjustment. I do realize that it will take a separate bill for CERS to get some relief, but we need to do what we need to do. The third comment was received from Carla Shuttleworth. And her message is, we deserve an increase in our retirement. Thank you.
Thank you, Sherry. We appreciate those comments, and we'll take them under advisement. And they will also be shared with the full CERS board. Is that correct?
Yes, that is correct.
Okay, fine. At a future meeting. Thank you so much. Next item on our agenda is the approval of minutes of our last meeting on November the 28th, 28th, correct, of last year. Would someone please move to accept the minutes as presented?
So moved.
Is there a second?
I'll second.
Are there any comments or adjustments that someone would like to offer? If not, we will proceed to approve the minutes. All those in favor of approving the minutes as presented, please indicate by saying aye.
Aye.
Minutes are approved as they have been presented. The first item this afternoon will be presented by Steve Weiler, and that is the Investment Office Quarterly Update. So Steve, if you would please proceed, we appreciate it very much.
Thank you. Sherry, next page, please, 6. Thank you. Good afternoon. So I wanted to provide a brief update on the preliminary performance for the first half of the fiscal year before we present a new real return investment opportunity. The returns presented are preliminary as valuations are still being finalized for a number of asset classes, and they're likely to change when performance is finalized over the coming weeks. Looking at the graph on page 6, you see almost a mirror opposite of what we saw in the first quarter. I think everyone would say this is the last quarter, the second quarter of the fiscal year, the last quarter of the calendar year was one most of us in markets would take every quarter if we could. Following that very difficult first quarter, nearly every asset class posted negative performance in the first quarter. Markets really staged a tremendous comeback, ending 2023 on a positive note across most of equity, fixed income, and credit asset classes. The markets increasingly priced in an easing in the Fed's monetary policy in 2024, driving an overall risk on sentiment. The rally more than offset the declines of the first quarter and pushed fiscal year-to-date performance into positive territory for most asset classes, as evident on this graph. Growth returned as the dominant driver, with indications that inflationary pressures were easing. The underlying U.S. economy remained resilient, with GDP printing stronger than expected, employment tracking back to pre-pandemic levels, and consumer confidence staying positive. Page 8, please, Sherry. Preliminary, again, caution, these are preliminary numbers. Preliminary numbers show that the portfolios performed in line with expectations and consistent with their benchmarks for the second quarter of the fiscal year. The CERS pension portfolio produced a return of 6.56%, and the CERS hazardous pension portfolio returned 6.68% versus the benchmark return of 6.45%. For the fiscal year to date, the CERS pension portfolio returned 5.04%, and the CERS hazardous pension portfolio returned 5.16% versus the benchmark return of 5.50%. Fiscal year to date performance shows a significant turnaround from the first quarter, which saw the portfolios down almost 2%. So the second quarter really boosted performance. Again, those are preliminary numbers, and we expect those to change modestly as valuations are finalized in a number of asset classes. Page 10, please. The public equity portfolio produced a return of 6.67% for the 6 months ending December 31st, underperforming the benchmark return of 7.26%. Relative underperformance in the U.S. portfolio was driven by the portfolio's larger exposures to small cap and mid cap stocks, as all of the individual strategies outperformed their respective benchmarks with the exception of the micro cap strategy. Underperformance in the non-U.S. portfolio was the result of the portfolio's modest overweight to emerging markets, which underperformed developed markets for the period. While the S&P closed the year within striking distance of all-time highs, and the NASDAQ had its best year since 1999, as we discussed throughout the year, equity market moves and health beneath the surface showed an extreme lack of breadth. The theme for the year was the Magnificent Seven, which we all know, which were up 76% for the year, driven by emerging AI narrative and accounted for over 70% of the S&P's index performance. This was also notable, and it was the first year in history where there were 3 sectors up more than 30%, tech, communication services, and consumer discretionary, while also having 3 sectors that were down over 2%, illustrating the extreme amount of dispersion under the surface of positive market performance. Page 11, please. Core fixed income portfolio produced a return of 5.41% for the first half of the fiscal year, outperforming the Bloomberg Aggregate Index by 204 basis points. Relative outperformance continued to be driven by staff's tactical duration positioning of the portfolio. For part of that period, for the part of the first half of the fiscal year, we were short duration relative to the benchmark. Core fixed income was unusually volatile over the last 6 months, with 10-year rates selling off over 100 basis points before rallying almost as much. The rally picked up steam as the FOMC offered little pushback against market expectations at their December meeting, with the communication about the likely course of monetary policy becoming decidedly less hawkish, as they saw the risks to achieving their dual mandate as increasingly balanced. While we've seen material moves in rates in both directions and current rates feel elevated relative to recent history, it's important to note that yields are only now back to historical averages for the first time since 2007. So while we haven't been used in recent history to rates at these levels, if we look back at a longer history, this is really more normal historical rate levels. So we would anticipate some, as we've seen to start 2024, calendar 2024, a modest increase in rates. We think we're probably establishing a trading range, especially in the intermediate to long part of the curve. Page 12, please. The specialty credit portfolio had a strong start to the fiscal year with preliminary performance of 5.87% through the first 6 months, compared to the blended benchmark performance of 7.07%. This is where we start to get into the asset classes where evaluations are really not final yet, most of everything with the alts in the private sector. So performance is very preliminary, and we still have a number of valuations that need to be finalized for December. We anticipate that once these valuations are received and finalized, performance relative to the benchmark for specialty credit will be closer to the benchmark performance. Page 13. The real return portfolio produced a return of 6.29% for the period, significantly outperforming the custom benchmark, which returned 2.44%. Outperformance, as it had been previously, was paced by the portfolio's MLP exposure, which returned over 12% during the period. The real estate portfolio produced an estimated return of minus 3.88% for the 6 months ending December 31st, versus the benchmark return of minus 4.93% as markdowns continued in the space. Page 14. The private equity portfolio produced an estimated return of 3.45% for the first 2 quarters of fiscal 2024, compared to the benchmark return of 6.58%. Performance for the portfolio is preliminary, especially for private equity. And as we know, there is a bit of a mismatch, both an alignment and timing between the portfolio and the benchmarks that's used, that especially when we see market volatility, we'll experience more of a dislocation between the benchmark and the portfolio performance, but those tend to normalize over longer periods of time.
So Steve, is that partly due to evaluation then?
So for the private equity, we have a number of valuations that aren't finalized for December. So we'd expect a modest increase in portfolio performance. The misalignment is really because we're using a public market benchmark plus a bogey to compare against. And obviously, they're going to be, especially during more volatile times, there's going to be a bit of a dislocation between our private equity investments and public market performance, especially when we include that bogey. So there's a misalignment of timing that's also on a lag. The index is on a 3-month lag, so that's not the most recent 3 months of performance for the index, but it's on a 3-month lag.
And I assume also they didn't benefit from the Magnificent Seven.
Correct. They certainly did not benefit from holding those investments.
Right. Okay.
Page 15 is simply a few highlights from the first half of the fiscal year. And really the one I wanted to point out has been one of the more significant drivers of performance that we've had in the portfolio. And that is to note the rebalancing that occurred in the core portfolio. And this is the culmination of the transition that we've discussed over the last several investment committee meetings. So we had implemented a tactical short position from a duration profile when rates were closer to zero. Core fixed income didn't serve as the ballast that it had The upside downside from a risk perspective was heavily skewed to the downside was staff's view. So we were significantly short relative to the benchmark duration. During the first 6 months of this fiscal year, across a number of legs, staff has rebalanced the core fixed income portfolio, moving the duration of the overall portfolio from approximately 3 years short to ending the calendar year, second quarter of the fiscal year, relatively flat to the benchmark. Part of that move included updating the guidelines for the Loomis portfolio to extend it from an intermediate ag index to the full U.S. ag index, extending the duration. A total of $1.925 billion was transferred from Lord Abbett's short duration credit portfolio, with $996 million of that moving to existing core portfolios and $928 million moving to the newly established internally managed core portfolio. Additionally, so that Lord Abbett's account is in wind down, holding a single CMBS security. They're looking for liquidity in that security, so it'll either be held till they find the right pricing or it matures. It's a short instrument. And once that occurs, that account will be terminated. That's all I had for that preliminary performance update. Obviously, we'll have a more robust review once valuations are finalized and at the next regularly scheduled investment committee meeting.
Thank you, Steve. Certainly.
Sure.
There's no
Sure.
question.
Take any questions?
Any questions? Right. If not, thank you very much for a nice report, and particularly for the observations about the second quarter. We'll take those anytime you can find those observations. They're very good.
Fingers crossed.
We can move on to the next item. When you present this, Steve, in addition to your presentation, which you've already got planned, could you kind of put this in context and kind of remind everyone of exactly what we mean when we talk about real return and the types of assets we typically include in that portion of our portfolio before you begin your presentation and recommendation?
Sure.
Sure.
Absolutely. And I think, real return or real asset, we've kind of used those a bit interchangeably. And to some extent, the real return has connotations, historical connotations, more, I would say, hedge fund related. So we've moved to kind of using a combination of real return or real assets. It's one of the asset classes, as we've kind of discussed when we initially moved the allocations and started searching for mandates to fill out that allocation. It really encompasses a very broad and varied landscape of investments. The most typical you'll see are TIPS, Treasury, inflation protected treasuries, or global inflation securities. You'll see commodities, private real estate, listed and unlisted infrastructure. What we really look, as opposed to a specific type of asset class, what we really want to achieve in that allocation is investment opportunities that not only have lower overall correlations to the more traditional asset classes in the portfolios, to the core fixed income and the public equities, but we look for investment opportunities that are less correlated with the drivers of performance of our other asset classes. In the session when we talked about potentially revising our asset allocation, we talked about how dependent the portfolio and most portfolios are primarily on growth as a factor. So they tend to be very directional, and they have a huge bias towards growth. So we want to look for investment opportunities that are maybe a little bit farther afield, and have less of a correlation or don't rely so much on growth factors for driving their performance. And that's what we're excited about, this specific investment opportunity, as well as the ones that were approved in the last fiscal year. We believe that this Saba Capital offers a real unique investment opportunity that satisfies our criteria for the asset class with a very differentiated source of return. We view it as asymmetric payoffs and having favorable standalone risk-adjusted return profile. So while we have a component of our real return, real asset class has some inflation sensitivity to it, which most of the investments will. We also want to have those investments that are less correlated. I hate to say negatively or uncorrelated, but will have less correlation to drivers of return, which ultimately will lead to diversification from impacts of especially market directionality. So that's what we look for in these types of investment opportunities. I think, our sizing has been, we don't place, unlike, where we see a core where there's less differentiation among strategies. These are pretty unique strategies. As we've seen, we've done, maritime partners. We did franchise sports investing with Arcos. We've done farm investing. We have MLPs in this. We've had different things with different commodity or inflation exposure. And this ticks the box is really having that differentiated source of return.
So TIPS would be a really good example of this. What about in terms of the reasoning and maybe the justification for looking for an additional fund manager? Are there funds that you're looking forward to invest to balance the portfolio, or it's just an opportunity that occurred, so you're thinking about recommending it this afternoon?
I think this is a relatively unique opportunity. It doesn't fit in, what I would consider our more traditional asset classes. And we really felt that, especially that that standalone risk-adjusted return potential for this investment is a nice complement to both what we have already in the existing real return or real asset allocation, as well as a complement to the broader overall portfolio. As we look forward, I think we want to take advantage of what the opportunity set is. Again, it's very broad. We could have, initially we could have dumped a large allocation into TIPS. That's not a very differentiated asset class. There's not a lot of achievable alpha necessarily in that asset class, or a commodities mandate. We looked hard at some different commodities mandates, and that may be something that we take a look at again. There's that one is a little more unique, and there's some different strategies that get deployed for the commodity space. But I really think we'll take advantage of whatever opportunities are available in the market. What we see as offering that differentiated source of return. Potentially inflation is going to be less of a concern, at least for the short term. So having, we already have a lot of inflation sensitivity in the portfolio already. So we will probably be a little less focused on that and look for things that we think are unique opportunities.
Thank you for that perspective. I think context is important. Also,
absolutely.
The other question I had in terms of sort of background before you get into your formal presentation, the question that goes back to some work that we did earlier, and that was the process that we would go through in terms of selecting new fund managers. And I think we had sort of the idea that there would initially be a phase where you would be looking for potential fund managers for a particular purpose. You would do an evaluation and maybe come up with 2 or 3 candidates to fill that particular need. As I view this, and maybe I'm wrong, that this is a recommendation absent of that process, or if you've done that, could you go through that for us?
Sure, and I'll let Anthony jump in as well, as he did the bulk of this. But I think there's a distinction within the process, and why the procurement and the IPS have very specific language regarding the process for evaluating and bringing managers to the investment committee for recommendation. Part of that really is, especially in the alt sector, these tend to be the search process tends to be different than what we would necessarily undertake for a public securities mandate, a large cap growth public equity manager. In this space, they're pretty unique in that the opportunities, there's not necessarily consistently a comparable strategy especially for the more unique strategies. They tend to be much more timing dependent as to who's in the market, who is who is sourcing capital at a period of time. It's not an open-ended fund where you can always hire someone to run a core mandate or to a large cap public equity mandate. So we evaluate. This is an ongoing and a continuous process in what I will consider the broader alternative space, in that we're always reviewing different strategies. There's not necessarily an apples to apples comparison between one strategy and a different strategy in this space. They tend to be very unique. There tend not to be, for some of the things we look at, a lot of managers doing the exact same thing. So I would expect that when we look at a public market mandate or a recommendation for a manager, that's where we'll see a broader set. As you'll see in Anthony's presentation here, the comparison was made that there's comparable strategies reviewed were 10 closed-end funds, but not all these strategies are the same. I think it's not necessarily accurate to say that all are bring the exact same approach and the exact same strategy. Again, part of why we like this is that it's a pretty unique strategy, and that means a differentiated source of return. So in this instance, I don't think this is a case where we could necessarily bring 3 managers that do the exact same thing. There's not.
Good. Thank you, Steve. I think we had talked about that there could be circumstances like that when we talked about the general strategy. So it's good just to refresh everyone. Thank you so much for doing that. So
absolutely.
Okay. Any other questions
I will,
before we start? Okay, please proceed.
All right, I will turn it over to Anthony here.
Mm-hmm. Sure, thanks everybody. Yeah, we're here to present an opportunity with Saba Capital regarding closed-end funds. This is an area they've been trading for about 10 years. Closed-end funds have been around a long time. They're kind of a predecessor of ETFs, retail investment product mainly, that gives investors exposure to different assets like municipal bonds or stocks in healthcare or energy or tech sectors. Even some hold private companies in them. But they're listed, and so they trade every day, and so they're valued by the market every day. But the thing, with rates going up and down and markets selling off, discounts have widened. And the reason why there's discounts for these usually is because they're sold and not bought to retail investors. And so if someone wants to be out of them in a couple of years, when it's time to sell, then there isn't a natural buyer. It's not like, Apple stock or something like that. This isn't something that lots of people are just normally thinking of and wanting to buy. These are just funds that people were sold, perhaps through their wealth manager or wealth advisor or things like that. And so discounts are usually what happens to a lot of these funds. And one of the reasons we're presenting this now is because discounts are near some of the widest they've ever been in history. So if you look at slide 24, please, Sherry, there's a chart in the middle here. Okay, so this chart here, what it's saying is it's taking all the trading days for 20 years, so 2003 to 2023. That's over 7,000 days. What it's saying here is that where the discounts are now in the double digits, and Saba is tending to look at funds with discounts of at least 15%. There's only been, of the 7,000 plus days that there have been in those 20 years, only 50 have been this way. So it's very unusual. And so that's kind of the opportunity that's happening here. Obviously, like Steve was just saying, the markets did quite well last year. And, the underlying assets in several of these funds did well. But the discounts can still remain given the trading dynamics. And so I guess what Saba is trying to do is to actively close the discounts, because the discounts are there. We can all look on our Bloomberg or just look on any kind of finance site that you want to, and you can see, XYZ fund is trading at, 85% of net asset value, right? And underlying this can be just stocks. Like the number one position that would be potentially be in our portfolio has just tech stocks. So, Microsoft and stuff like that. But you're getting it at 15 to 20% discounts. And so it's cheap, but as we know, things can stay cheap, indefinitely. So so instead of just buying your dollars here for 80 cents, Saba is doing things to exercise their rights and make moves to get the other 20 cents. And that's a differentiator against the other 10 managers that were considered, because there are strategies or people who invest in closed-end funds, just to name a few if we want to. Bulldog is one, as from that name. They're probably the most active maybe, but they're very small. the mandate that we're looking at would basically be the entire size of their assets under management. So that doesn't work for our how we invest. There's one called 1607 Capital, River North. There's a few other managers that comprise this set that we talked about. And for what either they just hold the closed-end funds, or they're too small, or some other combination, or why we chose not to go with them and recommend Saba instead. So that's what we're doing here, and I'm happy to answer any questions. Or we talked to them. I think I met them 4 years ago at a conference. They were founded in 2009 out of the Deutsche Bank credit trading group, and so they have that was their main area. But as they opportunistically find things in the market, they can scale up or scale down different strategies. Closed-end funds is one they've done for 10 years. It was relatively fallow a couple of years ago when discounts were narrower, although SPACs were of more interest because you could collect the treasury yield and then also have the optionality and use that to fund some of the other trades they had. So, but that has disappeared, and now the closed-end fund discounts have widened to a point where it's very compelling.
These securities tend to be long-term, right? That's why they're kind of traded for.
They're traded every day. I mean, it varies, right? Municipal bonds are not super liquid. Let me just read you the holdings for some of these. All right. So the top fund that they would suggest for our account, the top 5 holdings are Microsoft, Google, NVIDIA, Amazon. Okay. And this number 2 one, MasterCard, JP Morgan, Microsoft, American Express, Google. Okay. But then there's another one that has all pharma companies that, I haven't heard of them. And a private one, then there's several municipal bond funds. So those are all funds that, they are listed, they trade to some extent, but in this wrapper, or, they just get discounted because of the market's dynamics.
Have you been able to look into the 15% discount? It seems pretty significant. Was it due to interest rate phenomenon, or is there some risk factors involved as well?
It's mainly the supply-demand dynamics, but yes, when in markets that are more volatile, or with interest rates going up to affect a lot of the bond funds, obviously in the past year, then that's why some of them are at very wide discounts. So I mean, the basket of municipal bonds are at par. Like I was just looking one up. There's a California pollution control bond that's 5% due 2045, right? That paper is par or 103. So, but if you buy into these funds at 15% discount, that's what you're getting. It's just that in the wrapper that they're in, whether that's an MMU or, NAC, different, these are all listed things that you and I could go buy right now on our own accounts, but they are at a 15% discount. The question is that ever going to be closed? And, absent some activism, maybe it will, maybe it won't. Probably not, because the incentives are for the manager to continue the status quo, right? They're the ones who benefit when Saba is able to close the discount, either through having the fund be liquidated or merging them with an open-end fund or something like that. All the investors, everyone investing, including people at that firm, all benefit because their assets, gain from 85 to 100. So it's really the NAV or the assets under management that charge higher fees is what goes down for the managers, and that's obviously why they don't want to keep doing it.
In the discussion, that information you provided,
yes,
it seems like this manager, this firm, basically tends to have a certain strategy which is unique, and they get involved in some legal activities.
Yes,
if I understand correctly, is that a concern we should be concerned of? I think we're trying to get out of.
We aren't going to be sued. They have litigation with the BlackRocks and Nuveen's of the world, and are basically saying that their votes should be counted, right? So there's been ways that the managers can suppress the votes, because basically the reason why they would be able to get the funds to liquidate or merge is because they would get enough board seats with the shares that they hold and enact that. And so I think what these funds have done is, suppress their votes, either, saying, fine, you own 15% of this fund, but you only get to vote. No one can vote more than 9.9%. Or they can say, fine, you own 15%, but to win the election, you have to win a majority of all shares. And that includes shares that don't vote, right? I mean, do many people vote in these elections? Not really, right? So that's basically an impossible standard. And so that's gone to court to determine, does that violate the 1940 Act, which, they have won some rulings so far, because I think it was relatively clear that was the idea. Like, you have a share, you get to vote. And so that's why they've been successful in dozens of actions like this to close them, and that there's still more out there because there's large incentives for these managers to create these products. So.
And to be clear, it's I think we talked about this in the K investment committee meeting as well. It's while there's some arm's length to the litigation, obviously this is potential to be a litigation intensive strategy. But what I mentioned there, and I feel firmly is, if we look at the activism here that's taking place, it's to the benefit of shareholders of these funds, right? It's trying to unlock that discount, that value that rightly belongs to the shareholders of the fund. They tend to be retail investors, smaller investors, not necessarily institutional investors. So from a headline perspective, I prefer to be on the side of what would be perceived as doing the right thing for those investors, as opposed to, as Anthony mentioned, one of the incentives for the managers to fight this is because they get higher fees, right? I mean, this is the game. I would also say that, as we've seen, Anthony has some examples, and we've talked to Saba about the successes that they've had in realizing and closing these discounts and having all investors. It's not just us in the fund, right? It's not just whoever's investing in the Saba fund is getting that realization of closing the discount. It's every shareholder, again, which tend to be for these types of funds tend to be more retail oriented shareholders. But they've actually had success as well when they get involved. They don't have to, it doesn't end up in litigation. It doesn't go anywhere. Just knowing that this firm is involved in taking a stake or a position in a fund. They've had investment companies or managers of these funds actually actively seek to do something to find a solution that really is closing that gap, making the realization for the investors of the realization of the value of the assets.
Yeah, that's right. You can see an example of that on pages 26 and 27. The bottom of it is a press release from Goldman Sachs, in which they announced the liquidation of their fund, which was GER. It was actually an MLP fund. So in June, Saba was the largest holder, and they announced that they were just going to liquidate it. So obviously, it's being traded at 85%, 80 to 85% of the net asset value, and then the next day is basically par. And so you can see that in the next page on page 27. Right. That red line going up in the green circle is the discount just closing. So that is what their goal is. They did not have to litigate. I don't even think they engaged Goldman. They just were the largest holder after about a year of accumulating, and that's the outcome that happened. And the other thing about these, we also get another thing that kind of correlates with the real return. A lot of the strategies in this area tend to have recurring revenue or cash flows, and in this case, obviously municipal bond funds. MLP funds, different funds like that tend to have current income and are paid. So you still have the underlying assets. So you get any income and appreciation from the underlying assets. You're just getting into them at a discount that's hopefully going to close perhaps in 1 to 2 years is their general hold. Sometimes it's faster. It just depends on, or it's very lumpy depending on litigation. I think they reached an agreement with another manager around Christmas at the end of the year for a few funds. And also won a legal judgment around the same time. So it can be a lumpy thing. Obviously, that goes to how it's less correlated and a different kind of driver return for our portfolio, which is the goal for this area of the portfolio.
Anyone else have any questions or clarifications that they would like to pose?
Yeah, I've got a few questions.
Sure.
Let's start with the term of the investment. You indicated that it was basically liquid. Is it?
No, it's not. No, it's not liquid. It is not. Some of the underlying assets in the funds can be liquid, but no, this is not a liquid strategy.
So what's the actual term on the investment?
There, I think after an initial period, there's liquidity that you can request every quarter.
And the initial period is,
I think that's still to be determined since it's a separate account for us, but likely a couple of years, given that they have to accumulate this for us, and they can't just sell it all
okay.
immediately. So, but these funds, like we just said, are daily traded, but to accumulate a position in them, that it takes a while.
Okay.
Mhm.
How much of our money actually goes into the investments, and how much of it is going, as I assume, whatever tact they're taking as far as their activism, at the very least, involves the threat of legal action. Where are those costs coming from?
That is, I think that's spread among all investors because this would be a separate account for us. They have a fund that they run, and it's also part of the flagship strategy, which they allocate to this. So it's allocated among all the investors.
Yes, my question, following up on him, was of the money we invest,
Mhm.
how much of it goes into the actual equities or whatever else they're investing in, and how much of it is fees to deal with the litigation, etc.
Sure. The proposed fees is less than 1%, so that's lower than a typical alternative manager. But the performance fee is higher, and so that's going to be variable, obviously, and it has to be over a benchmark, which we are still determining based on what our account will look like. It's going to depend on what our account tends to look like. I think they've done this in the past for people who tend to have more, maybe a portfolio of municipal funds. So then then their benchmark is, the HYG or something like that. To add any value they add over that would be where the performance fee starts to happen. So it's kind of variable. I mean, I think the fixed part is something that we're trying to have be reduced, and then they would be paid for providing value. That's kind of the idea behind it.
Is this something you can negotiate?
That's what we will try to do. Yeah, we will work on that. It hasn't been determined. I mean, the benchmark hasn't been determined, and that's something we have to work on. I think we have a call for that on Friday.
Yeah, and again, as with any recommendation, this is contingent on successful negotiation of the documents,
Sure.
which would include agreement on the appropriate benchmark, the appropriate feeing of that benchmark, and a number of different factors.
So today, when we're looking at this, are we
Mhm.
going to give you approval to continue, or are we going to give you approval to actually, if you're satisfied, buy it? And of course, it's not us. We'll have to take it to the full committee, but
It's been approved by the K plan, which would be, but it has to be ratified. But we're continuing to work on it.
But what I'm
so that can go
asking you
forward.
is, do we get another vote once you've reached all, figured out all the details, or is this it?
This recommendation would be to approve a total of 175 million across all CERS plans, contingent on the successful negotiation of documents.
Okay.
I think
So it's fine. And then we'd have to take it to the full CR's committee.
The board would ratify if the IC
recommendation.
were to, if the IC were to approve the recommendation, it would go to the board to be ratified.
Okay.
I think Dr.
So this authorization recommendation would approve a maximum of 175 million, and then would subject to call based upon the negotiations with the firm. Is that basically how they would issue the calls for those funds?
It would be up to, yes, a maximum commitment. So it would be a commitment that wouldn't be called.
I think Dr. Milkman's question related to who determines successful negotiation.
That would be the combination of staff and legal.
Not us. Is that right, Steve?
That's correct.
Is correct.
Okay.
You indicated, I think, that you actually did entertain other options, and you chose not to present those for whatever reason.
That's correct.
you know, who were they?
I named some of them, but I'm happy to read them to you again. 1607 Capital, Allspring, Bulldog, Conan Steers, Cornerstone, Guggenheim, Matisse, Relative Value Partners, River North, YYY.
Okay.
Did they recommend pursuing this aggressive legal strategy as well? Was that a part of their strategy, or is this unique?
That's what makes it different. I think Bulldog, obviously, as you can tell from the name, they're interested in perhaps pursuing some actions like that. They also run $300 million, which is not going to be a fit for us.
Okay. Do you have somewhere what the other company's strategies were? You know,
I can get them for you if you'd like.
the question here is not just a question of the investment, but of a question of which strategies fit our fiduciary need best. I think that was
Right. Well, I think that they wouldn't meet the fiduciary need because I just wouldn't recommend them.
Yeah.
Like, I don't, if you're just going to buy the 80-cent dollars and just sit there, I don't think that's really going to do a lot for you. So
I think,
that's not really something I'd recommend you.
you know, brought up to start with that the IPS, you know, suggests you bring more than one option.
Right. But I mean, I wouldn't recommend it to you. That's the point. I don't recommend that. I don't recommend you invest with a manager that has only $300 million that we cannot comprise more than 25% of the assets for, and that does not have the scale or, you know, ability to pursue this kind of strategy. So I just wouldn't recommend it to you. Does that make sense?
Has Wilshire weighed in on this particular?
That is on page, let's see here, page 22 of the slides, if you want to look at that.
That's their due diligence. Have they weighed in on the strategy? I guess is my ultimate question.
That is, I mean, they are consultants, so that's their opinion. I agree with you. I tend to ask them, you know, what are you actually doing with your money? They have not put any discretionary clients in it yet, although as form follows, they may, because they did that for, you know, they follow some of our recommendations like Middle Ground, Aeromark. I mean, we joke about the finder's fee, right? But yeah, so I wouldn't be surprised if they follow this, but, you know, we'll see.
Yeah, and so to Anthony's, we have written a summary on this strategy, but this investment was sourced by staff.
Is it the strategy that's attracted you to this particular firm, or is that our current fund managers for this category of investments is reaching a point where you have a concern about the amount of investment we do through them? So are we principally adding another fund manager, or are we adding this fund manager because of the unique strategy that they are bringing to you?
We're adding a unique strategy. I mean, they also have another interesting strategy that is a tail risk, a carry neutral tail risk strategy. I haven't got there on that, but I mean, I think that's also a relatively unique offering. That's something that they also have, but that's not what I'm recommending for here. It could fit under here in terms of it's less correlated, but that's, again, that's not something that, you know, I felt interested in recommending at this point. But I think given the state of this particular market and where it is and their continued success, I mean, they've been doing it for several years, but there have been more legal wins of late, and they're hopeful that at the annual meeting for BlackRock this year, which, you know, runs several of these closed-end funds, that they would be able to vote their shares and create and close some discounts. So that is part of the timing as well.
And as we mentioned at the very start, so for this asset allocation, I think that given the uniqueness and the breadth of the landscape of investments, this is one where we would tend to, and we have tended to make smaller allocations. You know, unlike like I said, in large cap equities or core fixed income, they're not nearly as differentiated of asset classes. And so this is where we think it warrants adding more managers. You know, if we're going to utilize kind of our bandwidth for adding managers, this is a space where we think we can, you know, it can benefit the portfolios, and it's prudent to do so.
I think Bill has a question. Bill, please.
Thank you, Steve, and Anthony. I think you're answering our questions. I guess I would make a suggestion that would help us as board members in the sequence of your presentation. If you start saying, this is our universe, these are the unique things in the universe, this is the progression of how we analyzed. We looked at a number of candidates. We rejected some because of their size, because they didn't go all the way. You would just sit there. And we found this one is unique, and that is why we're recommending it to you. And then you start talking about the selected item. I believe that helps us to understand how you got to the place that you are today.
Yeah. Thanks. I can do that in the future.
Any other questions or comments or clarifications?
If you were to classify this, would this be a value fund as opposed to a growth fund, and that's why it offsets some of our other things going on with the magnificent whatever?
I think buying things below at a discount would probably tend to fall in the value classification or label. There is still some growth involved, obviously, and if the underlying assets are tech stocks or energy stocks or MLPs, then there's still some growth involved in that. But if you're buying it at 15% discount, then I think that would have some attributes of value. Sure.
And I think what we're looking for here as well is that part of that differentiator is it's not directional dependent as most of our other assets will tend to be. Even in an overall down market, there's still an opportunity to unlock that discount and generate excess performance that's not dependent on a directional market.
So you said this fund has been operating for how many years now?
Top itself's been for since 2009. They've really traded closed-end funds for about 10.
So what's their annual rate of return?
Okay, let me find that for you. That is on page 27. If you'd like to see.
Yeah, maybe I missed it when I was doing it before.
So they started a separate account there for since 2015, and so it's been about 11% annualized. It was higher than that this past year, with several of the discount closing events that we mentioned that occurred, and so that is a snapshot of their performance there.
Thank you.
Could you just clarify again in terms of the so-called legal action and unlocking? Go through that process, what exactly they would be doing, who would be the adversary that they would be focused on to accomplish their end in that process. I think that might be helpful to everyone.
Sure. Well, the most prominent one that they've been working on is BlackRock, right? Who has been, as we know here in Kentucky, very, let's say, ESG focused, right? But obviously the G is governance. And so, having an actually independent board that looks out for shareholders rather than the manager is ideally what you have. But that's not the outcomes that have happened. I think, like Steve mentioned, closing that discount would benefit to all shareholders. And obviously the main loser is BlackRock. So that is why they have been fighting with them. And that's who are some of the litigants. I think they've also been in litigation with Nuveen, Franklin Templeton, just your brand name folks. That's who we're talking about.
So those securities, would they be held in legal purgatory until something?
Oh no, they trade every day. You and I can go buy them right now if you want to.
Okay,
no, they're not purgatory.
Not a problem that way in terms of liquidity.
No.
Okay, that was my curiosity. Okay.
I mean, Saba also has its own, and we could put that as the 11th if you want that to be the comparable strategy. They have one that's Boaz's initials, BRW, and then there's also CEFS. You can trade any of those. They're also quite small, so they would not work for us as well. But they have similar, and they obviously can do, it's a different in our own account. But yeah, those are for people who believe or think that that's an interesting strategy. They can go buy it right now if they want to.
Any other comments from Steve or anyone? Other questions? on
Where
anyone's
do you
part?
think the performance portion of the contract is going to come out at?
Can you say that again? I'm sorry.
The performance fee, where does it stand right now?
Well, I think that was an initial proposal. If you look on page 28, the last page, so 25% of our benchmark. I mean, I was looking at 60-40. If that was what it ended up being, I don't think it'll be that. I think we have to look a little bit more at what we think the actual portfolio will look like, but it will be similar to that. It'll be a number over the benchmark that we decide and agree upon, and then that's what that performance will be. But it will not just be, like 20% or whatever. There has to be a hurdle of some sort. Even today, the hurdles that other managers have, over, 5-6% is pretty measly when that's what you get for cash, right? That's not anything special. So I think having it over a direct benchmark is very important, and that's more aligning.
I don't
We're going to pay it.
disagree with that. The returns you're citing on page 27, what fees are those net of? Are they net of the performance fees?
Yeah. Mm-hmm. Yeah.
So what are you proposing as a benchmark, and what do they want to have as a benchmark?
Again, I think that's something we have to decide. We had talked originally about having only real return funds, so it could have been all MLP, just only MLP or infrastructure related. There's ones that do utilities or materials. I think that's a decent chunk of the universe. But as we were saying, municipal bonds is obviously a large area, and other equities. So I think rather than constrain them, we are interested in just having exposure to their best ideas. I think that's so understanding what that would shake out to be, whether that's more of the discounted fixed income funds at this point, or others. That's something I think we're going to determine. But
Yeah, there's an element to it as to what the appropriate benchmark is, and then typically part of the negotiation here is we want to get that hurdle to be as high as possible, right? The manager's pushing. We want to land somewhere that's realistic, that really would be meaningful return. So as an example, in other benchmarks, they could use 1.5 times a public market benchmark from a performance hurdle standpoint would be something that would be an example of how it would be set. So the first step is making sure that the benchmark itself is appropriate for the investments that will be in the strategy, and then what on top of that potentially would actually be used to establish the hurdle.
Mm-hmm. Yeah.
Just to be clear, the 175 million.
Mm-hmm.
Is there another commitment from K, or is this a combination of K and C?
K's already independently made their commitment, yes.
And what's
So there's 75 million.
Is it separate? So the total would then be 250.
That's correct.
Just out of curiosity, why are we supplying more when they have a larger asset base?
You have a larger asset base.
No, we have a larger asset base. Okay.
It's proportional. The idea is around a little over 1% around 1% of the portfolio position for the whole portfolio. That's the idea.
Okay.
They would have the same relative exposure, yes.
Mm-hmm.
It becomes part of the same transaction ultimately, right?
It would, yes.
Mm-hmm.
That was
So if their board does not approve it and our board does, then we're just going to deal with us?
Potentially, yes. If only K or only C approved the investment, we would make the determination whether it was still warranted given the sizing. It's something that we still wanted to do. But in this case, if C were to approve it and K were not, certainly $175 million in 110 basis point exposure would be warranted for this portfolio.
Who is actually going to hold this asset? Is this going to be one of those combined holdings, or is this going to be C owning their 175 million and K their portion, or what? What's the intention here?
It would be unitized similar to existing investments.
Okay.
So it's a separate account structure. So there would be a separate account for the pension trust and a separate account for the insurance trust.
Any other questions? What's the pleasure of the committee? I guess the action would be a motion to recommend this particular action to the full CERS board. Is that correct, Steve?
Yeah, Vicky may weigh in here, but I think it would be a motion to approve the recommendation as made, contingent on successful negotiation of the agreement, and then subsequent, the board would take it up for ratification.
Right. We're really recommending it to the board.
Correct. So the investment committee motion is a motion to approve the investment of C into Saba at 175 million, subject to successful contract negotiations. And then the entire board can ratify that or not.
How quickly do you need the board to decide?
I assume it would be on the agenda at the next regular meeting.
Regular meeting, okay. So it's not urgent.
No, there's no urgency here, but
Okay.
right. Okay. There are no more questions. Would someone like to move to recommend this to the CERS board, or is there no such initiative?
I'll move to recommend it. I'm not sure what I'm gonna vote on, how I'm gonna vote yet, but.
I'll
There-
second.
Second. Motion's been made and seconded to recommend the agreement to acquire this invest fund manager, subject to negotiations, to the full CERS board. And made and seconded. Any further discussion? If not, then we can proceed to vote. All those in favor of recommending this action to the full CERS board, please indicate by saying aye.
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 I will vote aye, but I'd like to make a statement with that. I'll vote aye just to move it to the full board for their consideration. I still have some significant questions.
Okay.
Yeah, I feel the same way.
So the motion is accepted. And it will be transferred to the full board for further presentation and discussion by the full board. Did you have other comments you would like to make?
I have a comment. Do you think you'll know more
As far as the
time it's at our next meeting in terms of?
Sure, the
negotiation?
negotiations, yeah, negotiations are ongoing. I would imagine we will have confirmed what benchmark we're going to use for the account, and what the performance fee specifics will be. Is there any other specifics related to information that you would want?
Those are the ones I'm
Those are the two
interested in.
Okay. We
I don't
will
know
certainly
about-
provide an update, and I hope we are successful in negotiating those in the short term.
Yep. Can you guys outline some of the reservations you have as well beyond is it most of the fees and expenses, or are there some other ones that we can address, or at least come back to you with further information?
Lack of choice. Process.
So are you saying you wanted three different funds to invest in, and we would choose it? Is that right? I'm not saying three. I did say three, but you want some choices.
I think from my perspective, and this is maybe not off topic. We've touched on each one of them. I have concerns with our following of the investment policy statement. with regard to terminating managers without any board involvement. And in this case, while we did not say bring us 3, I think the intent was certainly there that we were to see choices, whether they were choices in strategy or choices in investment opportunity. I think that was the intent of the way it was passed. And I just have some concerns over not, I don't want to say following the letter of the policy, but certainly bypassing the intent.
Okay. That's fair. Okay. Any other special items that should be included in discussion?
You've
Nope.
addressed this, but okay? You addressed this, but do we really want to get into a space where their philosophy is suing people? It's just.
I think, Bill, that's my principal concern. I think
it's the exercising of their rights, right? I think that they, as shareholders, that is what they're trying to have, right? That people's rights should be enforced. And
which rights are you talking about?
Shareholder rights.
Mm-hmm.
Such as in
They're exercising their rights as shareholders.
Their rights as shareholders. They own 20% of the fund, so they should be able to vote that amount, right? It's just like if you and I somehow own 20% of Apple or whatever, then we'd probably get a board seat or something like that, or be able to have some say in it, right? We don't, but or no one wouldn't, but that's that's the idea.
Do they intentionally buy stocks that they can then exercise their rights, or just happen?
That's exactly what this strategy is. That's exactly what's happening here. Mm-hmm.
Well, their voting privileges are outlined in the prospectus when they buy into the fund. That part's neither here nor there. The other part that goes along with that, ultimately, the asset class that we're dealing with, depending on which portfolios they're dealing with, are duplicative of some of the other assets that we already own, whether they're selling at a discount or not. If the market dives, the discount's going to dive.
I'd suggest if you have questions,
the underlying assets would go down. The discount would probably remain, to where it was, but
the discount tends not to have directionality to it.
Mm-hmm.
So,
and if it did widen a lot, then there would be an opportunity, obviously, right? They're wider now than most of the times, and so that's why it's an interesting opportunity, right? These discounts went back to like 10%, then it's just not that compelling, right? It's a lot of work for not that much upside.
So I guess you've heard our concerns. So when you make the presentation next time, try and address them.
Say the last part again. Sorry, I missed it. Next time, something.
And I think also Bill's suggestion in terms of the presentation approach would be helpful to the other members of the full CERS board as well. I think we've had a really good discussion today. We appreciate Anthony and Steve for your hard work and your detailed presentation, and also your participation in our discussion. We appreciate that very much. So please take that with you. If there are no other comments or questions, would someone please move to adjourn our meeting?
I'll make that motion to adjourn.
Second, please.
Second.
Motion has been made and seconded to adjourn the meeting today. All those in favor say aye.
Aye.
Meeting is adjourned. Thank you for everyone for being here and taking and participating very actively in our discussion. I think this is what I like to see in our meeting, to have a full exchange back and forth, and I think we benefit from it. So thank you very much for being here and participating very actively. That's all for today. Thank you very much. Bye now.
Thanks for everybody for your time.
Bye.
Bye, thanks.